Let's bring in Carl Tannenbaum, Executive Vice President and Chief Economist at Northern Trust, former Senior Vice President of the Chicago Fed, and joining me in studio is Eric Green, Portfolio Manager at Authentic Asset Management, also former economist with the Fed. I want to start with you, if I could, Carl, just in terms of the reaction and that sort of hawkish takeaway on the part of the markets. But were you really surprised by the line that Jerome Powell was towing?
Well, I think that the news that they will not be cutting as much as previously thought in 2024 is not entirely new. I think the Fed has been trying to steer the market in that direction for some time. The premature assumption that we would get that kind of reversion was based on very optimistic views on where the path of inflation might be going. I think one of the things that a lot of central banks around the world have in common at the moment is a difficulty in seeing 6 months forward to what inflation is going to be. A lot of the rules of thumb, Phillips curves, money equations, and the like that served central banks very well up to the pandemic are now no longer working. And the new dynamics are hard to anticipate, thereby prompting the kind of interest rate conservatism that we're seeing in Frankfurt, in Washington, and also now in London.
Eric, you have talked about the interest rate picture in terms of what the Fed says versus what they will do. And we kind of saw this in the Bank of Canada as well. They're concerned about the optics of a pause.
Yeah. And so, it was interesting yesterday because it was a meeting that was not supposed to really generate much of any sort of reaction. But, this is one of those things where it's almost like reality bites sometimes because we've been talking a long time about this lower rate profile in 2024, what was more wishful thinking than anything else. It's very clear that the policy message is evolving from how high we're going to go to, hey, wherever we are right now, we're going to be staying here a lot longer. And they know that just by staying where they are, they're going to tighten pretty aggressively over the next 12 months because inflation's coming down.
It's interesting you say that because I think the message and sort of what I was getting at with the Bank of Canada's view is that they're afraid that even saying a pause is going to be interpreted devishly.
Yeah, absolutely. It's really interesting. I look at the price action equities over the last 6 months or so, and I've been surprised at the strength of growth that this coming year. We've talked about this a lot on air. But I think a lot of this is FOMO insofar as, if you look back at the 6 last tightening cycles, if you bought equities right at that last rate hike, man, you did really, really well. But what people have to remember is one of the reasons why equities did so well is because the average time lapse between that last rate hike and when they began to cut rates is surprisingly short, just a matter of months. So in this case, the market's been pricing in that sort of profile. They've been wanting to load up with equities. I've been saying for some time they can't do that because inflation is going to be remaining more sticky than I think most people expect. And all you need to do is look at the ratio of job openings to the unemployed, and you see that they have a long way to go.
Well, and jobs certainly do filter into that inflation picture, Carl. So does energy and oil. Did you get a real sense, Carl, about how the Fed might deal with oil and it complicating the inflation picture?
That is a commodity over which central banks have very, very limited control. And unfortunately, it's spoiling what had been an otherwise positive picture on headline measures of inflation, not to mention the fact that energy does have a nasty habit of working its way through transport and other means to the prices of finished goods and even services. So as we do the puts and takes, let's say, for the next 6 to 9 months on inflation, that is one that's going to be in the liability column and may require central banks to move just a little bit further. If I could add one other thing that often gets overlooked and frankly wasn't discussed as much at the Fed meeting is that both the Fed and the Bank of Canada have been reducing their balance sheets pretty aggressively. And one of the things that we don't have a lot of data on is what so-called quantitative tightening does to inflation. So here again, the Fed does still have a tightening posture with its balance sheet, but we don't really have a good idea of what kind of impact it's going to have inflation over what period of time.
And also what kind of impact, Carl, it's going to have on the financial sector. I note that a number of the regional banks, almost all of the regional banks right now, are trading down. We obviously saw that blow up in March because of the rapid increase. But what does higher for longer mean for the financial sector? Can it withstand that in addition to the tightening that you're talking about?
Great question, Amber. A couple thoughts. Firstly, the interest rate risk problem, which was so troublesome for a handful of medium-sized banks earlier in the year, has been the subject of intense focus inside financial companies here in the United States and among regulators. I'd be a little surprised if we had another flare-up simply because of banking system problems related to interest rate. Secondly, financial conditions and availability of capital is a bit of a mixed bag in this country. In the United States, only 30% of the credit used by households and businesses comes from banks. The vast majority comes directly from the financial markets in asset-backed securities and then corporate bonds. And there, the news has been a lot better. Credit spreads, as I'm sure Eric can attest, have gotten very skinny, making credit more available. And there are private sources of capital, private equity lending pools that are growing very rapidly to take up the slack that the regulated industry is unable to provide. So as the Fed met yesterday, I think they probably saw a mixed view of financial conditions.
Eric, do you agree with that assessment in terms of how it's going to affect the health and stability of the financial sector?
Yeah, absolutely. I think that's a great point, Carl. And by the way, it's always nice being on with a former Fed official. You know, when I always think of shadow banking, I always sort of think about my days back at Countrywide and what happened there, just because we don't have a really good clue in terms of what's going on there. You know, we talked a year ago, I think, remember, about this great experiment in terms of policy tightening and how far they have come. If you look at the inflation numbers for the Fed, you know, the real story here, just to pick up on a theme from Carl, the real story in inflation is no longer going to be headline. It got down to around 3%. It's going to be around 3 to 3.25%, maybe 3.5%, pretty much over the next year. That's pretty much baked in the cards. The real story is going to be in core inflation. Ultimately, that's where the Fed wants to target themselves anyway. They themselves expect it to go down about 100 basis points. So they're not going to raise rates in November or December because they know that they don't have to. They just can't signal that they won't. But they're going to be staying lower for longer and in the process tightening. When I look at the cumulative effects of quantitative tightening, the higher rates filtering into the economy, and don't forget this, there's also a refinancing agenda coming up in the next year or so where more and more companies are going to have to refinance, especially in commercial real estate. And that favors stronger, larger companies over smaller companies. But in its totality, you look at the broad spectrum of risks, and you ask yourself, well, where do I want to be in this? And for our money, I think that you just want to be much more cautious than aggressive.
Well, and on that point, and Carl, I'd love for you to pick up on this. I'm going to ask about recession because you almost hear the Fed talk like this, like it's a done deal that we're going to get this soft landing, and we nailed it. We raised rates at an unprecedented level. Inflation's coming down, and we're not going to get the economy sort of careening into a problem spot. Even as history says, we're not even, on a timeline basis at a time where we typically see recession show up from the first rate hiking cycle, those long and variable lags. How do you think about, when the slowdown comes and how often we are going to get a slowdown? Are we going to get used to maybe frequent but shallow recessions?
Another great question. The soft landing is a very elusive concept. We've really only had one here in the United States that I can remember in all these years, in the middle 1990s. And there are those who say that we got lucky as opposed to being skillful with our policy. By the same token, Amber, there have been several situations in the last 30 years where it looked like we were going to stick a soft landing and then something sudden struck. .com crash and is a good example that could throw us off of what looks like a very gentle glide path. There are, as Eric highlighted, a number of candidates that could upset that trajectory and leave us with something that's a little bit more difficult to manage. So our own recession probabilities for the next 12 months are only about 20 to 25%, well down from what the industry had a year ago. And it's simply because the strength of the economy has withstood so far a lot of monetary tightening. And I'm not sure that there is that much left in the lags to hinder the momentum of economic growth.
What do you think, Eric?
That's interesting. Well, when you said we nailed it, I got a little nervous because, I just remember back in 2008, people thought that we had nailed it in the spring of 2008, and the Fed was being very, very hawkish. And I'm not trying to say that that's the sort of environment that we are sliding into. I think that, you know, when you look at this 40-year downtrend that we've seen in rates and easy money, and you've seen a very significant break of that downtrend, and how this is going to wash out, I don't think anybody really knows. And in terms of lags, we know that the surpluses built up over the COVID years have padded and you know, some of the impact of these rate hikes. But we're starting to see, you know, good old-fashioned higher delinquencies, higher charge-off rates. Are they a problem right now? No, but you begin to see some of these things leaking into the data. So I don't know what the lags are. I know that they're long and variable. They can be 12 months, they can be 24 months. For me, it's hard to see how we have a soft landing, and I don't discount that. I just think that it's a lower probability than most probably expect, just because when you raise all of these issues in terms of finance and balance sheet management, I think what I'm concerned about is something occurring in places where we don't see.
Gold has been an area that you've been keen to, you know, put into your portfolio,
Yep.
but recently it's just been kind of listless over the past couple of months,
Yep.
and it's down again today. How
Yep.
are you thinking about what does it take for gold to work?
Well, right now, higher interest rates are hurting gold, right? Just because of the opportunity cost of holding that asset. Inflation's going lower, so that's also another strike in terms of gold. Central banks are big buyers of gold. They'll be even bigger buyers going forward. So I think there's a natural floor around there, but I don't think that you're going to get that big leap forward in terms of the gold market unless you're going to have a more, say, significant inflation problem than we have, or some systemic risk issue that's always difficult to forecast. But it's always good to have as a hedge against the unforeseen.
And Carl, you know, gold is one way to look at it. One of the more interest rate sensitive areas of the market, of course, is housing. On the S&P right now, those resilient home builders are really getting clipped. And they actually, in a weird way, benefited from rising rates because nobody wanted to sell their homes. So you had to buy sort of these new homes. But how do you think about this higher for longer environment hitting the U.S. housing market?
I have some friends who have 3% 30-year mortgages here in the United States, and they're not moving anytime soon. That said, the countervailing force that you're hearing a little bit more about here in the United States is that we have an undersupply of housing, certain types in certain places, and so actually building activity has been picking up. Those ultimately may be rental units as opposed to ones that people purchase. But you have both the disincentive of high rates, but then the essential nature of trying to have enough dwellings for people. And so the construction industry has actually not had a bad 2023.